Welcome to Daybreak Australia. I'm Haidi Stroud-Watts in Sydney, where markets have just come online.
I'm Annabelle Droulers in Hong Kong. We're counting down to Asia's major trading opens and the top stories this hour. Japanese stocks set for a positive open with Korea and China closed, and just a half day of trading in Hong Kong. Wall Street offering little direction.
Janet Yellen warns of a potential failure among non-bank mortgage lenders, telling regulators and lawmakers that they need to closely monitor risks.
And we hear exclusively from the CEO of Korean financial giant Shinhan about buffering their billion-dollar exposure to risky US property. All right, let's kick it off this morning with a rate decision just coming out of Latin America. Peru cutting its benchmark rate by 25 basis points to 6.25%. This is really what have been seen by economists here. But importantly, when you think about the amount of easing that we're seeing from Peru's central bank, we're now at 150 basis points of a reduction since that cycle kicked off in September of last year. What's happening in Peru is that we're really seeing annual inflation that's coming back down lower, around the 3% mark. It has been a bit of a surprise to economists, but this chart here puts it in perspective because we've basically seen all Latin American central banks starting to cut their rates, so sort of getting ahead, Heidi, of the Fed.
Yeah, and very, very interesting as we continue to kind of watch the landscape of expectations that are building for other central banks as well, right, as we get into this latter part of the cycle. Great chart right there when it comes to LATAM central bank rates. But, Belle, let's get you into the start of trading as we head into the end of the week and the start of the Lunar New Year holidays. And, of course, that's really kind of the narrative that is dictating what we're facing at the moment, right, when it comes to stocks and how quiet things are potentially going to be, given that a lot of markets around the region are either already closed or will end trading early in the case of markets like Hong Kong today. This is a picture, though, here in Sydney. We're seeing a little bit of downside, a mixed open on Friday for Sydney stocks and some of these other markets that are actually trading. You can take a look at the market closures and changes here. Mainland China and Taiwan, South Korea, Indonesia and the Philippines and Vietnam are closed. We're seeing partial trading in the session today for Singapore and Hong Kong. And we are seeing that kind of muted start to trading here in Sydney, up by just about, down, I should say, by just about 0.1% there. We're also watching yields, Australia and New Zealand yields climbing in the early part of the Friday session. After US Treasuries fell for a second day on Thursday, we saw that selling coming even as US government debt was sold to the tune of $25 billion at those 30-year bonds. It was a lower than expected yield. Still, though, a sign of pretty healthy, robust demand there. The Aussie dollar holding at 64.94, and we're watching for the setting when it comes to the yuan as well. There's quite a bit of pressure that is starting to build, Bell, when it comes to the onshore yuan to weaken past that official line.
Yeah, certainly something to track, Heidi. But you mentioned how Aussie market's looking fairly flat. Well, take a look at their lead as well, because we had US stocks really just struggling for direction in the prior session. Bond markets, they were digesting another big sale of treasuries. We still had stocks hovering around record highs, but still it was that sense of caution that prevailed across investors' psyches here, because we've got the consumer price index revisions taking place Friday. And actually, if you cast your mind back to this point last year, that update was significant enough to cast doubt on the overall inflation progress. So perhaps a little bit of wait and see ahead of that. And of course, that's what we've been hearing from Fed officials over the course of this week. It has been that pushback, tracking what Powell said in the latest press conference, but telling policymakers and investors, the markets, it's really about patience. And we heard from the Bank of Richmond president, Thomas Barkin, exclusively. Take a listen.
Gratified to see inflation coming down, hoping it continues to come down, and I think we've got some time to be patient. If I could get these kind of numbers sustained and even better broadened, that's what I'm looking for, sustained and broadening.
Joining us now is Brian Van Kronkite, Senior Portfolio Manager at Allspring Global Investments. And Brian, I'm curious for your views, because we've really heard this, as I said, over the past few days, this continued pushback on rate cuts. At the same time, we know easing is coming and the US economy is holding up pretty well. So what are you looking at most closely, Fed officials or what you're seeing in the underlying data?
We want to focus on the data. Ultimately, the federal officials are also focused on data. So the market loves to try and get ahead of this, try to predict the next change. But the reality is the Fed has told us what they're going to do. They're going to keep watching, keep observing, and looking for inflation to stay below 2% persistently, not touch 2% and then start slashing rates. be below 2% persistently. The risk is, though, that while we're waiting for that to happen, the employment situation could be getting worse. And if it gets worse and we see unemployment move higher, the market likely will take a move lower from that because the fear is the Fed's tipping us into a recession. So we're watching the data. Specifically, we're watching the employment market to see if that moves before inflation gets down low enough for long enough.
And of course, we're in the midst of earnings season as well. And what are you tracking from that? And what are the key themes that you've seen so far?
Seen a few things. We've seen companies actually do quite well when it came to Q4 numbers, with a few exceptions. But guidance is very conservative in my mind. Guidance is coming in with a lot of doubt about not just the U.S. economy, but economies globally. Europe is still slowing down. China certainly is slowing down. And almost all companies in the U.S., as you go up cap, can't escape the impact of China. And so we're watching the guidance. We're seeing companies who are concerned. So our focus as stock pickers and portfolio managers is not so much on trying to navigate these various economic directions, but what are these companies doing specifically on their own to drive their own destiny? How are they using their balance sheets and their capital to invest in acquisitions or R&D or buybacks? That's where we're focused today, to try to pick the winners from the losers over the course of the next 12 months.
Brad, it's interesting you talk about the inevitable exposure to China, because I think for, certainly the last year and prior to that, US investors have given a pretty big shrug when it comes to what happens in China, right? Are we seeing less of the American exceptionalism and more of, I guess, a globalist approach now?
Well, I think that shrug is because they're uncomfortable, right? We can look at the two different dynamics. There's two dilemmas happening in China for U.S. investors and for global investors, frankly. One is that your company's exposed to that, and so you have dropping sales and challenging margins as a result, and that's putting pressure on it, especially relative to expectations. We came into the year 2023 thinking that China was going to rebound. The zero COVID's over. We'll see a growth of the economy. That just hasn't happened. It's been very disappointing. But there's a second dilemma, which is structural, right? What's going to happen geopolitically? What kind of multiple do you put on an earnings stream that comes from China if you're not sure if they'll be able to sell into China or be welcome in China in 2 years or 5 years? And so that's another challenge. So I think the shrug is more of, I don't know what to do with it. So how can I try to avoid it? How do I try to minimize my risk and look elsewhere if I can as a U.S. or global investor?
Elsewhere global, does that include Japan, which is obviously one of, I think probably two of the hottest Asian markets outside of India as well last year? It's interesting you say that you're actually not in a rush. You're not worried about, I guess, a FOMO trade?
I'm not in Japan right now. Look, I think Japan could be really interesting over the next 5, 6, 7 years. But I don't know if that moment is the next 6 months or next 12 months. It will happen. But if you look at the potential through our process is all about how companies use their balance sheet to drive a unique future, right? How can they use that capital in an offensive way? And if you just model out the Japanese cash flow streams, Japanese balance sheets, they're ridiculously undervalued. But that doesn't take into consideration the governance factors, the culture factors, which are very real and very okay. But as those evolve, which I think they're starting to evolve, the upside potential in Japanese equities is massive. But as an investor, timing matters. And so we're doing a tremendous amount of work in that country right now, looking for businesses that are looking to shift that mindset, looking to embrace what I'd consider now to be a more Western culture of governance. So they do step on that gas a little bit by using their capital more efficiently to drive higher ROEs, higher ROICs, and ultimately higher valuations. But I don't think you need to rush today. I think you can be patient and do your work now and just wait for that right moment.
I'm just taking a look at your notes, Brian, and I can see that CBRE is one of the stocks that you're highlighting here, commercial real estate focus, of course. I'm curious what you're making of the stress that we're seeing in this sector.
Well, there's a few things here. The stress that we're seeing, I think, in many cases is overblown, right? There's an exaggeration of the impact of all commercial real estate because the focus is on office, as an example. Office is part of it, but it's not everything. Now, there's two things I like about CBRE. CBRE has a very stable cash flow stream through facilities management, but they also have a transaction-based business, which has gone down because interest rate moved higher, causing buyers and sellers not to agree on price. But CBRE is investing through that. And when that interest rate stabilizes, which I think it is now, we're going to see a lot of transaction volume. A lot of companies need to, and owners of real estate need to go out there and roll their debt. They need to increase their equity, and that's going to create transactions. And CBRE will be a winner in that situation. So there's a little bit of turmoil in the space right now, but in CBRE's case, all they want is activity. They're not exposed to valuation to a very big degree. So CBRE is a great way to take advantage of what now is stress in the market with a good long-term opportunity with a solid business model.
Brian, great to have you with us. Brian Van Kronkheid, the portfolio manager at Allspring Global Investments. We're still ahead. Shinhan CEO Jin Ok-dong talks to us about managing risks for their exposure to US real estate. This is his first interview since taking charge of the financial giant. Our exclusive is next. This is Bloomberg. We are hearing from the RBA Governor, Michelle Bullock. They're speaking before a parliamentary panel. They're saying that the economy is well placed to deal with global risks, interestingly saying that they don't need to be in the inflation band before cutting the key rate. The governor says there's some way to go when it comes to reaching that CPI target, but certainly not ruling out a rate hike, but not ruling it in either. So really treading that fine line there when it comes to signalling. She says that an inflation rate with a 4 in front of it is not good enough. There's still some way to go from the midpoint of our range. The board hasn't ruled out a further increase in rates, but neither has it ruled it in, attempting to bring inflation down while preserving as many of the recent gains in Australia's labour market as possible, referring to that as how Phil Lowe, her predecessor, referred to it as that narrow path. This is her first testimony as governor. We had her helm that first RBA decision of the year, with the first under the revamped communications regime, with that press conference, the immediate release of the updated economic forecast, and now straight to that parliamentary testimony as well. Michelle Bullock there getting questioned by lawmakers, saying that she'll do what we need to do to get inflation down. That comment about the RBA not needing to be within that inflation band before cutting that rate, we are seeing a bit of a move there in the Aussie dollar in reaction. Well, from Australia to the US in terms of the outlook, and Treasury Secretary Janet Yellen says US regulators are monitoring risks stemming from non-bank mortgage lenders. She spoke at a Senate Banking Committee hearing.
FSOC is very focused on that because non-bank mortgage companies lack access to deposits which banks have. There is concern that in stressful market conditions, we could see the failure of one of these.
Let's bring our banking regulations reporter Katanka Johnson there in Washington. So we did hear from Janet Yellen saying, warning of the possibility of a failure for one of these institutions or more than one of these institutions. What does that now mean for, now, I guess, versus then in the future for non-banks?
Treasury Secretary Yellen today made it clear that now that the Financial Stability Oversight Council has powers to deem a non-bank as systemically important or too big to fail, that really the panel is studying what risks those non-bank firms may hold, but also if they faced a shock, if there were stressors and one failed, just knowing that there might be certain counterparty risks to the system. And basically this was a signal that now that the panel has powers to deem these firms too big to fail, that there's studying that's underway into this sector.
And so just talk to us more about that significance if you are saying that there is a too big to fail label that's being applied here, possibly.
Possibly, though not yet. The regulators were made clear. Really, Secretary Yellen and others on the FSOC want to get more granular detail from non-bank mortgage firms, understanding in what ways they might, if there were a shock to the system, how they might respond, understanding their balance sheets and the tie-ups they have with the banking system. She also spoke to concerns about not having deposits the way traditional banks do. And while it'll be, the last time the FSOC designated a non-bank firm as a SIFI, it took about a year and a half. So many, many months ahead before any such firms will be designated. But 6 months ago, the panel did not have powers to deem these firms as SIFIs, and now they do. And so this is the beginning of a signaling that, yes, they're paying more attention to these firms and having to study, what roping them into regulations, just like big banks, would mean for the regulators.
Yeah, and as you said, a failure of one of them is possible. Well, that was our banking reporter there, banking regulations reporter Katanga Johnson in Washington. Turning to South Korea now, because Shinhan Financial says it's reinforced its buffers against a roughly $1 billion exposure to risky US property bets. In his first interview since becoming CEO last year, Jin Ok-dong told us exclusively that the lender can stay resilient amid a wave of credit concerns in real estate.
Our overall exposure to U.S. real estate is about 2.4 trillion won, and I think the risky tranche amounts to about 1.4 trillion won. For the 1.45 trillion, we've built up about 20 billion won in provisions, and for the 1.4 trillion tranche, we've built up about 20 billion won in provisions. I'm thinking that's probably going to be managed within that.
Jin also told us that South Korea will probably lift a ban on short selling in the first half. He says the company is reviewing how it markets equity-linked securities, or ELS, after some lawmakers warned of risks for retail investors.
We have stopped selling ELS, and it is a temporary suspension. We temporarily suspended the sales because public and media opinion in Korea right now regarding everything about ELS is bad. But it's a choice to be made by consumers. And there are actually many consumers who are asking about ELS over the counter, even now. So I think we should resume on a limited basis, depending on the atmosphere. But I think the way that we've been selling and the system for sales needs to be reviewed and improved. I think it can be seen as a short break.
You mentioned you might need to review how some of the products were sold and maybe some of the marketing information. Once you resume selling these products, do you see a need to change the way you've sold them to the public?
Most is being sold over the retail counter, but what I'm saying is that we could limit that and induce sale over a more specialized counter. We have a wealth management channel that we call PWM, and we're looking at conducting the sale via that counter. Asset allocation is the most important thing for general retail customers. And we're looking at ways to limit sales and encourage sale via counters where we can guide and consult to make sure that asset allocation is done correctly. We're looking at a lot of different things, and I think that's probably what we'll do.
And as a final question on the ELS topic, are you expecting to are you expecting to settle anything? Do you expect a fine? Have you provisioned anything for compensation, for example, or is it too early to say at this juncture?
The authorities are doing on-site inspections now, and I think differences among banks will have to be sorted out. And once that is sorted out, I think we'll have to come up with a mutually acceptable solution.
Short selling ban in Korea, and you run a securities arm. And I'm wondering what you think about the optics that's sending to the world at a time when Korea wants to show it's opening up its financial system, its financial market, and becoming an international finance center.
I don't think the suspension of short selling will last long. And I don't think it will last long because the authorities also adhere to the principle that we need to allow investors to make decisions freely in order to move forward toward the global market. I think it is intended to complement the short selling system, because there are incomplete features to the system, and there are some shortcomings that need to be addressed. Once completed, short selling should be resumed as soon as possible. It is most important to create an environment for investors to invest freely, but you can't continue to take something that has shortcomings. I think the inspection and supplementary work will be done quickly, and I believe authorities share that perception. Authorities will resume as soon as possible when those things are addressed. So I'm looking forward to that.
What's your sense on timing? So we know it's going to come. We know this is not permanent, but could you give us a sense of how long do we have to wait?
Actually, I think we need to complete some IT systems to improve the shortcomings that have been found now. And as for the timing of that, I think it will probably be resumed during the first half of this year.
That was the Shinhan CEO, Jin Ok-dong, speaking exclusively to our markets co-anchor David Ingles in Seoul. And you can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers go to DayBgo. It's also available on mobile in the Bloomberg Anywhere app. You can customize your settings so you only get news on the industries and assets that you care about. This is Bloomberg. Indonesians head to the polls next week, choosing a new president and government to lead the country for the next 5 years. Investors will be closely watching for signs of policy continuity or change ahead in what's Southeast Asia's largest economy. Bloomberg's chief international correspondent for Southeast Asia, Haslinda Amin, has more on what's at stake.
Campaigning has been intense in Indonesia to win the support of more than 200 million voters spread over a vast archipelago with 17,000 islands. It's a three-way fight for the top job. Leading opinion polls is Prabowo Subianto, a military general turned defense minister who's accused of human rights violations. Prabowo ran against outgoing President Joko Widodo in the two previous elections and lost both times. Now the two are teaming up. Prabowo's vice presidential candidate is Jokowi's eldest son, prompting criticism among people who see the pairing as an attempt to create a political dynasty, rekindling Indonesia's past. Ganjar Pranowo, the former governor of Central Java, was once supported by Jokowi, but they have since fallen out. He has the backing of the largest coalition partner, the PDIP, or Indonesian Democratic Party of Struggle, which incidentally is also Jokowi's party. And finally, Anies Baswedan, an academic who became the governor of Jakarta. He's been the most critical of Jokowi's policies, and his running mate has strong ties with the largest Muslim organization. This is a consequential election with a lot at stake. During his 2 terms in office, Jokowi helped to propel Indonesia onto the global stage, establishing stronger ties with both the US and China.
We think that there will be very important implications to the region. Like Pak Jokowi has pushed for like mineral downstream investments. A lot of investments have been coming in from China, from South Korea, from the US, from Europe. So it could have some of the implications on the regional economy, who and whether Indonesia will continue with the policies of President Jokowi's administration.
At home, he spent billions of dollars funding infrastructure projects and green lighting policies, such as moving the capital from Jakarta to Nusantara and expanding the high-speed rail, prompting debt concerns. Indonesia aims to become the 4th largest economy in the world by 2045. Whether it gets there or not may depend on how this government shapes its policies and priorities to drive growth. Haslinda Amin, Bloomberg News.
Another political story that we're tracking closely, Pakistan's vote count is facing lengthy delays, with the Election Commission receiving results from a small minority of polling stations. The Commission has so far offered no explanation for the delays. The party of the former Prime Minister, Nawaz Sharif, has so far said little on the elections. Rival Imran Khan's PTI is claiming on social media that its independent candidates are leading in the polls. More to come here on Daybreak Australia. This is Bloomberg.
You're watching Daybreak Australia, taking a look at how oil is trading so far. This is WTI, of course, online for about half an hour so far. And you are just seeing, again, that slight extension, that uptick here in the session. It's really being driven by these doubts over the Gaza deal for the hostage negotiations that are being carried out between Israel and Hamas, and Netanyahu, essentially the Israeli Prime Minister, dismissing any sort of potential ceasefire and saying that he sees no other solution than total victory in the war. And so that has led to that price gain that's also being added to by trend following algorithms. So a bit of algorithmic buying, Heidi, is also playing into the complex that we're seeing for oil so far.
Yeah, and speaking of the Canadian province of Alberta, Bell, is among the biggest oil producers in the world. Output rose above 4 million barrels a day for the first time last November, matching China's output. Production is surging as oil sands companies prepare for an expansion of the Trans Mountain pipeline, which runs to Canada's Pacific coast. The Premier of Alberta, Danielle Smith, is in Washington this week, drumming up business for the province's energy resources. She joins us now from our studio in DC. Premier, really wonderful to have you with us, and we do appreciate your time on what is undoubtedly a busy trip. Can you give us an idea of what's been achieved, some of the discussions and deals that are being been on the agenda and on the table for your visit?
Well, one of the main things that I wanted America to know is that we really are the largest supplier. When they are importing oil, they're importing it from Alberta. 56% of what they import to augment their own supply and their own production comes from us. And we want to make sure that people understand that we want to be a responsible and are a responsible provider of this resource. We have a target to be carbon neutral by 2050 using technologies like carbon capture, utilization, and storage, as well as expanding out into ammonia and hydrogen production. And we really look at the challenge that we have as being one where we address the dual problems of solving global energy poverty at the same time as reducing global emissions. So we are in the process of transitioning away from emissions, but by no means are we transitioning away from production of oil and gas.
The transition prospect, though, makes it a complicated, interesting landscape when it comes to demand. And you said that you want to double oil and gas production from your province. Oil output recently at record highs. Natural gas output, I think, about the highest since 2009, I should say. How do you see the doubling of that in a world that is shifting, very quickly away from decarbonisation?
Well, I look at America. They found the pathway as well. I mean, they continue to increase their production. At some point, their fields are going to fall off in production. They're going to need to replace that supply, and we believe that Alberta is going to be ideally situated to do that. The other thing I'd say is that we've heard loud and clear from our international partners, particularly South Korea and Japan, that part of their model in moving away from coal is to be looking at things like hydrogen and ammonia, and we believe that we should be that principal supplier to not only our American friends, but also our friends around the world. So I look at the entire picture of a reduction of global emissions as one being where the wealthy nations will achieve that target by 2050. China has a target of 2060. India has a target by 2070. And as we develop the technologies to be able to develop these resources with fewer and fewer emissions, that's going to be able to ensure that we're able to meet that global demand for energy, as well as have a lower and lower emissions target. So I think that we can achieve all of that.
So, Premier, I'm interested how the Trans Mountain pipeline expansion plays into that, because we know it's been more than a decade in the making. And what will its construction mean, do you think? And as well, what sort of message does that timeline send to other investors out there looking at potentially more pipelines being built in your province?
Well, I would say America is one of our dearest friends and best trading partners and our principal and in some ways only customer. We supply the rest of Canada as well as supplying America. But when we now can reach Tidewater with both of our natural gas resources through Coastal GasLink and LNG Canada, which will be up and running in 2025, as well as through Trans Mountain Pipeline, we have the ability to diversify our customer base. I think we still will have America as our principal partner and our principal customer. But once you have those products on the ocean, they really can go anywhere. And so I note with interest that the Americans have said that they might be pausing on their LNG export. I look at that as an opportunity for us. If we can be an additional supplier of the world of this vitally important energy source that's also lower emissions, lower polluting, I think that we have a role to play in being able to expand our markets that way.
And so which markets are you looking at in particular? For instance, Asia and oil sands crude, would you be looking to export any of that to Asian refineries? How much do you think that they would actually be buying as well?
Well, I would say that the value proposition on these heavy forms of crude is very high because they can be used for a variety of things, not only combustion and diesel, but also for asphalt. And whether we're driving gasoline-powered vehicles or zero-emissions vehicles. We're all going to need roads to drive them on. We also know that a barrel of oil already has 6,000 different products that you can make out of it. And so being able to find those additional markets so that they can be refined locally to whatever that unique mix is for each nation, we are absolutely open to having those conversations. And I think that that's going to be a new era for my province as well as for Canada, that we can finally talk about the ways in which we can meet that global demand. So I'm looking forward to having that conversation. On the issue of LNG, I know that Japan is very keen on either having LNG export, but I think principally they're interested in ammonia. And one of the things about Alberta is that we have one of the best geologies in the entire world for carbon capture, utilization, and storage. My officials tell me that we have the ability to sequester the equivalent of all of the emissions that have already been produced by man so far, to give you some idea of just how great our geology is. So if we're able to capture the CO2 and then in turn export ammonia to be able to meet that market, I think that opens up an entirely new conversation with our friends in Asia.
Premier, geopolitics is a constant overlay when it comes to energy markets, right, as well as trade. We've just been talking about trade with Asian markets for your province. Do you imagine, if we look at the possibility of a second Trump presidency, we are seeing Donald Trump leading in the latest Bloomberg News Morning Consult swing vote. Does that bode well or ill for your province and you know, the businesses that you kind of have control over in terms of global trade?
Well, in our current environment, Alberta and America are trading $161 billion worth of products. So I would say that we will have a strong and healthy relationship, regardless of what the politics are in the White House. I always do get concerned when I hear politicians talking about putting in new taxes and America Buy First policies. What I'm hoping is, whether it's a Republican White House or Democrat White House, that we look at the special relationship that we have through the U.S. Mexico-Canada Free Trade Agreement, and that we look at having North American energy security, North American supply. I think that having Canada and Mexico work in conjunction with the United States is really the way that this continent can be a powerhouse. So that's what the other part of the message is, that whatever protectionist measures or extra taxes come in, I hope that Canada can carve out an exemption.
I want to ask as well on the ownership of this Trans Mountain pipeline, because we know that the Trudeau government has said it doesn't want to be the long-term owner. Bloomberg has been reporting potentially on some sale of it, but we understand from some Indigenous leaders in the community that process has stalled. Where does the sale stand, and what should they be doing as well?
We've been very successful with what we've called our Alberta Indigenous Opportunities Corporation, essentially putting up a backstop so that we provide a loan guarantee so that these kinds of assets can be transferred into the hands of Indigenous ownership. We were able to backstop a major deal that Enbridge negotiated with 23 nations. So now they get a long-term revenue stream of dividends. And we've already told our federal counterparts that we're prepared to use our expertise as well as that kind of support, so that we can make sure that there's a significant portion of that pipeline that ends up in the hands of the nations in Alberta and British Columbia who are going to be impacted. So I think we've got a successful model that has proven out that it can work. We've actually had so much success that we've increased the amount of loan guarantees we're willing to backstop up to $3 billion. And if they were to follow the model that we've put forward, I think having the First Nations as an anchor owner would then go a long way towards enticing other owners. I don't foresee that being a huge difficulty in them getting it into private hands, but they do have to get the Indigenous ownership there first, I do believe.
Premier, thanks so much for your time. That was Danielle Smith, Premier of Alberta, Canada, and leader of the United Conservative Party. You can watch us live and see our past interviews on our interactive TV function, TV Go. There you can also dive into any of the securities or Bloomberg functions we talk about, plus become part of the conversation by sending us instant messages during our shows. This is for Bloomberg subscribers only. Check it out at TV Go.
Well, Well, ARM shares surged almost 48% in New York after AI spending helped bolster the chip designer's forecast. And the CEO, Rene Haas, told us that the remarkable opportunity presented by AI is still in its early stages.
This is really the results of strategies that were put in place a number of years ago that are now just really starting to come to fruition.
Yeah. When we think about the vindication, when we think, though, still about basically more of your technology going into more types of equipment, you've managed to see a diversification out of phones. Paint us the strategy of ARM going forwards, because many would say, actually, you're not just, well, the overall designer of chips, you're basically making the chips. You're fabless in some way. How do you see that relationship going forward with Qualcomm, for example?
Well, a lot of folks, as you said, didn't really understand the company well and where we fit. And obviously, we had a lot of growth attached to the smartphone market. But ARM is in a lot of devices that people may not naturally think about. We're in a Tesla vehicle. We're in a Ford F-150. We're in a Ring smart camera. We're in a Samsung TV, a Samsung smart appliance. So just about every device you can think of has ARM inside. And just about every device you can think of needs more and more compute, particularly as AI is now driving a whole new demand cycle.
Talk to us about AI. Jeffrey is really singling that out, the analyst there, saying that this really shows you're a beneficiary from AI. But where does the AI focus come? You, of course, were at NVIDIA before. They are all about AI accelerators. And I'm interested as to whether or not that would be an area that you get into other than servers.
Well, right now, NVIDIA is a great partner. Their Grace Hopper chip, the super chip, uses a lot of ARM CPUs in combination with their GPU, which is a really, really great solution for high-end AI training in the data center, as well as inference. But when you start moving to smaller devices, say smartphones or PCs, well, AI is going to run there too. If you look at some of the recent announcements by Samsung and Google relative to their smartphones, there's a lot of things such as circling an image on a browser and then having that browser go off and do search based on the circle. That's AI. That's actually running in a smartphone. And what we're seeing is really a drive for more and more compute capacity to run these AI algorithms, some that people don't even know what they are yet. But what designers want to do and need to do is future-proof their designs with more and more compute. And that is really driving a strong licensing cycle for us in terms of more demand.
That was the ARM CEO, Rene Haas, speaking to Bloomberg Technologies' Caroline Hyde and Ed Ludlow. And ARM was a key focus for SoftBank, or is a key focus for SoftBank as it repositions its strategy around AI. So that was sort of really what came out of SoftBank's earnings yesterday, where we saw it swinging back to profit after 4 quarters of losses. Let's get more on that now and bring in our tech reporter, Minjong Lee, for us in Tokyo. Minjong, I'm curious, what was your key takeaway from the numbers that came out?
Like you said, they swung to profits for the first time in 5 quarters, and their Vision Fund unit also reported profits helped by a recovery in their assets. And of course, while ARM's results didn't have a huge impact on the earnings itself, as you see from the share price reaction, the surge in ARM's shares are having a very positive impact on SoftBank's own shares, because SoftBank owns 90% of ARM. And there was a lot of focus around how the company, SoftBank, is focusing on ARM, trying to maximize ARM's technology for future growth into AI, and how Masayoshi-san is very busy, always thinking about what to invest that can help maximize the potentials of ARM. But another key thing was their new investment activity remains quite small and minimal. So there's a lot of questions surrounding what is happening with new investments, both at the Vision Fund and also at the group level. So that's a key question that's hanging.
We got some answers as to that Paytm stake, right, before the shares plunged.
So one of the things SoftBank is doing, they keep offloading a few of the key assets they have. And one of them was Paytm. We spoke with the Vision Fund CFO yesterday, Navneet Govil, and he told us that a majority of the stake has been offloaded before the recent share stock crash by Paytm, and based on uncertainties that was surrounding Paytm. And now SoftBank only owns about 5% of Paytm compared to roughly 18.5% that SoftBank owned around the time of Paytm's IPO. And I think we can expect not just Paytm, but some offloading of shares of these key assets by SoftBank going forward as they continue to kind of manage exits and new investments going forward.
Our Bloomberg technology reporter Min-Jun Lee there with the latest on SoftBank. Take a look at some of the other corporate stories that we're tracking this hour. And Bloomberg has learned that Goldman Sachs is under investigation over whether it improperly charged fees for futures trades. Sources say the US regulator has sent subpoenas for information about those transactions. It is the latest regulatory headache for the bank, which paid $50 million last year to settle at least 4 CFTC cases. ExxonMobil plans to leave Equatorial Guinea within months, ending almost 3 decades of oil drilling that made the country an OPEC member. The small West African nation became one of the world's hottest oil provinces around the turn of the century, but output has since dried up along with foreign investment. Bloomberg has learned that Saudi Arabia is set to hire banks including Citi, Goldman and HSBC for a secondary share sale in Aramco. Sources tell us the world's biggest oil exporter is also in talks with other banks over the offer that may come in the next few weeks. The follow-on offering would raise about $20 billion, making it among the biggest in recent years. Australia's Woodside Energy is in talks to buy liquefied natural gas from several US export terminals, including Energy Transfer's Lake Charles project in Louisiana, which isn't yet under construction. Lake Charles is one of the projects affected by the Biden administration's pause on granting new LNG export approvals. Energy Transfer's request to extend its existing permit for the plant was denied last year. We do have plenty more ahead here on Daybreak. This is Bloomberg.
Richmond Fed President Tom Barkin says policymakers have time to be patient about rate cuts, pointing to a strong labour market and continued disinflation. He told us exclusively that he's looking at data around this time of year with a cautious approach.
I think the data has been remarkable, and it's been remarkable across the board. Yeah, the fourth quarter GDP, 3.3%, the jobs numbers last month. And I think all of them do talk about an economy that's fundamentally healthy. That's a great thing. I am always cautious about numbers around the turn of the year. I mean, they're big seasonal adjustments. A great example would be the jobs numbers last month. The actual jobs were actually down 2.5 million because a lot of the retail folks who were hired for Christmas, then got laid off after. But the seasonal adjustments bring it up to a positive 353. So that's a pretty big seasonal adjustment. I look hard at it. I'm glad to see it coming in. That's the best data we have. But I'm not sure I'm going to take too much out of any one month.
Markets are obviously interested in if and when the Fed is going to cut, emphasis on the when. And I know you've said we don't have to be in any rush, but with the data like this, basically, are you telling people, we're doing fine with rates where they are?
Well, I have said you don't have to be in any particular hurry. You've got a dual mandate with employment and inflation. And the employment side of the mandate, I mean, it's actually operating at historic levels, 3.7% unemployment, job gains we talked about, initial claims, job openings. It's a very strong labor market still. And so gratified to see inflation coming down, hoping it continues to come down. And I think we've got some time to be patient.
I know you said you don't have a roadmap for rate cuts. Yesterday, Carlyle Group Chief Executive Harvey Schwartz said investors should not be thinking the Fed would cut rates 5 times this year because that would imply something's wrong with the economy. I assume you would agree with him.
Well, it's hard for me to get into the market forecast because there's always 2 elements going on in those forecasts. One is rate normalization under a healthy economy and inflation coming down. But the other, of course, is the economy takes a wrong turn and you come down faster. And so those things are a weighted average. To me, there is certainly a model that you take rates down quickly. That's not a model that's good for the economy. That's just one of the things that could happen. And then there's the model where you toggle rates down as the economy comes back into balance.
Well, how do you make a judgment then on when you think it'll be appropriate to cut? What are you looking for? The phrase I think the chairman and others have used is measurable progress toward the 2% target. How would you define that?
If I could get these kind of numbers sustained and even better broadened, that's what I'm looking for, sustained and broadening.
Richmond Fed President Tom Barkin there speaking exclusively to Bloomberg Surveillance. Take a look at the setup as we get into the start of trading across Asia, and it is going to be sort of holiday quiet, right? A number of major markets across the region are, look, let's face it, either already off for Lunar New Year holiday, or we're seeing holiday shortened trading for the likes of Hong Kong, for example. So it is going to be lower volumes and really a lack of guidance in terms of how much trading action we see in the days to come, and particularly today. We are seeing a little bit of upside there when it comes to trading in Australian equities, up about just shy of 0.1%, really. We heard from RBA Governor Michelle Bullock in her parliamentary testimony saying that inflation doesn't necessarily need to be back within the band for the RBA to consider rate cuts, but really kind of trying to tread that fine line between signalling too much in either direction. We're seeing Kiwi stocks off by about 0.4% there. Nikkei futures signalling upside there, 0.4% higher. We are seeing the yen potentially facing more downside pressure, but equities and Nikkei set to climb after we heard from the BOJ Deputy Governor Uchida suggesting that policymakers won't hike quickly even when they do finally end negative interest rates in Japan. We're seeing S&P futures looking pretty flat at the moment. And just a reminder, market closures in China, Taiwan, South Korea, Indonesia, the Philippines and Vietnam. When it comes to Hong Kong and Singapore, they get an early end to the day.